Let us look at what is minority interest. Let us say company A acquires 80% stake in company B. So company B's shareholder are left with only 20% stake. At the end of the financial year, let us say company A reported PAT of 100 crores and company B reported PAT of 20 crores. Now in the consolidated financials, of A, it reports profit after tax before minority interest as a consolidated figure of 120. Now if you observe closely, out of the PAT that B has contributed, A holds only 80% of that. 20% still belongs to the shareholders of B. So what belongs to shareholders of B is returned back in the form of minority interest, which is 20% of 20, which is 4k or 4 crore. Okay, which is 20% of 20. So your PAT after minority interest is 116. Now consider, instead of this 20 crore being a profit, had it been a loss of 20 crores, how the picture will look like. So at a consolidated level, A would have reported PAT before minority interest of 80 crore, right? And if we apply earlier logic, only 80% of this 20 crore loss belongs to A. 20% of this 20 crore still belongs to the shareholders of B. So because we have assumed all the losses over here, we need to regain those 4 crores in the form of gain from the shareholders of A, shareholders of B. So it will be 84 crore. So in this case, this becomes the minority interest, and this is PAT after minority interest. Now this PAT after minority interest is further used for appropriation purposes. This minority interest goes in the balance sheet entry, and that is calculated as balance sheet entry of last year plus minority interest of current year minus dividends paid to B's shareholders. So this is balance sheet entry of current year minority interest. So this is how the balance sheet entry of minority interest in the balance sheet gets calculated. So that's about it on minority interest. Thank you.